Okay, good morning. Today we're going to finish up Chapter 10, which is about stockholders' equity. We have a question out there right now, so you want to get into learning catalytics if you're not already there. But our question today is about Treasury stock, and we started talking about Treasury stock on Monday. And Treasury stock is a company's own stock that it has purchased back. Perhaps it's purchasing back its stock to increase its earnings per share, or to have stock to give employees as part of performance incentive. For whatever reason, it's buying its own stock back. When a company buys its own stock back, it reduces stockholders' equity. It offsets stockholders' equity. So Treasury stock is indeed a contra-stockholders equity account. So this question, yes, Treasury stock is a contra-stockholders equity account. It reduces stockholders' equity. If we buy our own stock back, we're reducing stockholders' equity. Okay, so that question will be open for a few minutes, and I'm not going to announce when it shuts. So if you're getting here now, be sure you log in and get the question answered. A couple announcements before we get into, again, reminder, the Chapter 10 homework is due this weekend. I sent out step-by-step videos for homework problems yesterday. I think we're going to get through all of them. By the end of today, we'll be through all of them except one, but they're there for you if you need them. And I wanted to talk about the Extra Credit Project briefly today. The Extra Credit Project is an accounting cycle tutorial in My Accounting Lab. It's under homework, and you can do it. It's 10 steps, and basically the accounting cycle is the process of recording transactions, posting them, preparing a trial balance, and preparing financial statements. So it's the whole cycle. And this is a quote-unquote homework assignment. You find it in the homework in My Accounting Lab, and here's the details on it. If you complete the entire thing, there are 10 steps. It will add 2% to your course grade, your overall course grade. For example, if you have an 88 average at the end of the course, this extra credit will make your grade 90%. Okay. The My Accounting Lab or the accounting cycle tutorial temporarily counts in your homework score. There's no way I have to make it not count in your score to let you do it, so you're going to do it. So if you do it and you've got 20% on it while you're working on it, it is going to drag down your homework average. But as soon as the semester's over, as soon as everything's in homework-wise, which would be Saturday before finals week, I will omit that from your score so it will no longer count. That said, too, I'm pulling that score out, whether you have 20%, or 40%, or 100% on it. All of it's coming out of your homework average as of Saturday, probably Sunday after the last week of class. It is due by Saturday, December 12th at 11 p.m. Okay, there's no lateness. Everything's due by then. You need to allow enough time to do it. Do not wait until Friday to do it. It will take a significant amount of time. 2% onto your overall course grade. I have never done anything this major in terms of extra credit. I typically don't offer extra credit, period. And 2% onto your course grade is the equivalent of scoring 10 points higher on an exam, I believe. So it's pretty big deal, and that 2% can absolutely push you up to a higher grade depending on where you end up at. To get the 2%, it's an all or nothing. You have to complete all 10 steps with a score of at least 80% on each step. I've seen a couple people who complete 9 steps and leave one in the middle blank, and then their overall score is above 80%. That's not going to get you the credit. You have to complete all 10 steps and have a score of at least 80% on each step. It's a good thing to do a couple steps at a time and go back to it. So the extra credit is there. You do have to complete every single step in it, at least 80%. And you have multiple tries at it, so it's not like you get one time. But you do have to complete all 10 steps, no partial credit. You have to get at least 80% per step. So that's the extra credit. It's due in probably about roughly 3 weeks or so. So if you're interested, go ahead and take a look at that. Thanksgiving's coming up. So just a reminder, we do not have class on Wednesday next week. There is no online class either. Whatever we don't finish on Monday for Chapter 11, I'll put video links up to help you out. So we do have homework due next week, but we are not physically having class. Well, not physically and not online Wednesday. We do not have live class, period. Okay, so that brings us to one of the homework problems for today. So on Monday, we had talked about Treasury stock, and Treasury stock, again, is when we buy our own stock back. And when we buy our own stock back, it reduces stockholders' equity. So this exercise, it's telling us, here's the components of this company's stockholders' equity, and then it tells us during the year they purchased Treasury stock and resold it, and we're supposed to record the purchase and the sale. So we're going to do that. So the first thing is we purchased Treasury stock at a cost of $34 million. When you purchase Treasury stock, this is the easiest thing. When you purchase Treasury stock, you're paying cash for it, so we're going to credit cash for $34, and we're going to debit Treasury stock. That's it. So when we purchase Treasury stock, what we're going to do is we're going to debit Treasury stock, credit cash. That's it. We don't have to worry about par value or anything when we're dealing with Treasury stock. We just buy it, okay? So we're reducing cash, we're reducing Treasury, we're increasing Treasury stock, which reduces stockholders' equity. In this transaction, we're decreasing assets and we're decreasing stockholders' equity. So when you see a company doing what they call a big buyback, GM's doing a big buyback. They're buying their own stock, and they're going to be reducing their assets and reducing stockholders' equity simultaneously. Okay, so the next transaction here, we resold Treasury stock for $15 million, and it tells us that $15 million Treasury stock had cost them $6 million. So to do that part, if we resell it for $15 million, it costs $6 million. On Treasury stock, we never, ever, ever recognize a gain or loss on selling our own stock. It just doesn't happen. So what we're going to do here is we're going to say, well, we sold it for $15 million, so we're going to have cash debited for $15 million. We're going to credit Treasury stock for the cost, which is $6 million, and then the difference goes to paid-in capital. So we're going to see a debit to cash for $15 million. We're going to have a credit to Treasury stock for $6 million, and then a credit to paid-in capital for the difference. So you never, ever recognize gains or losses on Treasury stock transactions. So that's one of those rules. Okay, yes. The question is, what's the reason why we don't recognize gains and losses on our own stock? Because you're opening the door to tons of manipulation. So that was, yeah. So, but you get the benefit of it. You increase your stockholders' equity. It's certainly still a good thing to do, but you're not in business to buy and sell your own stock. That would be like a shell game. Because another thing you could do, if you could recognize gains and losses on your own stock sales, you could leak insider information like rumors in the market and make your price go way down, and then you know what's coming up, so you can manipulate your stock price, and that would just open up the door to all kinds of bad things. So, okay. So, and again, when I want to go back to this first part. When we purchase Treasury stock, the entire cost of it goes into Treasury stock. It reduces stockholders' equity. So when we buy it, it goes into Treasury stock, reduces stockholders' equity. Notice we don't have to worry about par value. We just do the cost. And then when we sell it, we sold a portion of it here. We're going to be crediting Treasury stock for the cost, and then the extra goes into additional paid-in capital. Okay, so then the last question, it says, overall, how much did stockholders' equity increase or decrease as a result of these two transactions? So we're looking for what happened to stockholders' equity. So if we go back to our two entries, treasury stock here, the first entry where we bought treasury stock, stockholders' equity decreased by 34. And then the next entry where we sold treasury stock for 15, then treasury stock or stockholders' equity went up by 15. So what we have for this final question then is we purchased it for 34. That reduced stockholders' equity. That's why I put a minus sign around it. And then 15 was what we received from selling the treasury stock. So, and what I received, I meant the treasury stock plus the paid-in capital added together. And so the overall stockholders' equity, and I abbreviated it SE here, decreased by $19 million by these two transactions. Because treasury stock, the cost of it reduces stockholders' equity. When we resell it, whatever we resell it for, increases stockholders' equity. So that homework problem should go pretty quickly. It's just those two components and then figuring out the impact on stockholders' equity. Okay, we're going to do a couple questions now related to treasury stock. This one is not out yet, so I'm just going to talk about it and then I'll deliver it. So Casey's Computers purchased 4,000 shares of its own $10 par value common stock for $92,000. So this is Casey's Computers is purchasing its own stock, treasury stock, for $92,000. As a result of this, when we look at this, if you think about this, I'm going to go backwards for a moment. Keep in mind, hold in your mind that we purchased treasury stock for $92,000. So if we go back to this homework exercise that we just did, the first transaction where we purchased treasury stock, okay, when we purchase treasury stock, think about what happens. We purchase the treasury stock, we're going to have treasury stock being debited, cash being credited. What's happening here, treasury stock reduces stockholders' equity when we purchase it. So we reduce stockholders' equity, we're reducing assets, and we're doing it for the cost, right? So this question then, so keep that in mind. Question. Okay, so what happens when we purchase 4,000 shares of our own $10 par value common stock for $92,000? Okay, the question is out there now. Okay, let me give you a huge hint on this question. You do not need to do any math, period. Okay? You do not need to add, subtract, or multiply anything. So I would say probably about 25% of you probably need to change your answer. Okay, so remember, treasury stock, when we buy it, we record it at cost. I'm going to be closing this question in about 10 seconds. Okay, so the answer on that is stockholders' equity would decrease by $92,000. Okay, when you deal with treasury stock, par value is irrelevant, doesn't matter. You record it at cost, stockholders' equity decreases. Okay, now the next question that I'm putting up, before we get to it, I want to go back and talk about this one that we just did. Okay, when we resell treasury stock, so we've purchased treasury stock and now we're reselling it. In this example, we sold the treasury stock for $15 million. The treasury stock had cost us $6 million. So we're told those two facts. So when we record treasury stock, when we record the sale of treasury stock, we're going to be getting cash in, so cash increases. So we're going to credit treasury stock for our original cost. Now the difference between the original cost and what we got, in this case $9 million, that gets credited to this paid-in capital from Treasury stock transactions account. So that difference doesn't go to a gain account. It goes into paid-in capital from Treasury stock transactions. Okay, and notice that we're crediting it because when we're selling Treasury stock, stockholders' equity is increasing. We're going to be crediting Treasury stock. We're going to be crediting this paid-in capital from Treasury stock transactions. So just keep that in mind when we sell it. We credit Treasury stock for the cost, and that difference goes into the paid-in capital. Okay, so then that'll get us to our next question. This one, if Treasury stock is sold at a price greater than its reacquisition cost, greater than what we paid for it, the difference is what? What do we do with that difference? And on this one, you do want to refer to that journal entry we did, the second journal entry on that homework exercise that we just did, because this lines up with that one exactly. Okay, I'm going to be closing this in about 10 seconds, so get your answer in. Okay, and yes, we do credit it to paid-in capital from Treasury stock. Okay, so now we're going to leave Treasury stock and we're going into a new topic, and the next topic is retained earnings, dividends, and stock splits. So this is kind of a little bit of a lot of different things, kind of interesting. Retained earnings, we talked about retained earnings before. Retained earnings is this running total, the accumulation from the beginning of our corporation to current of net income minus net losses minus any declared dividends. And that's going to give us retained earnings, and that's accumulated over our corporation's lifetime. So it's a running total, kind of almost like a running score of how we've done. So retained earnings is not cash, it's a running total. And you would normally want retained earnings to be positive. Some companies have negative retained earnings because they've not earned a profit or they've lost so many years. Caesar's Palace, Caesar's Entertainment Corporation, you know, the place that operates Caesar's Palace, they have a huge negative retained earnings because they've lost money so many years in a row. They're going through bankruptcy again, and they're hoping to wipe out a lot of debts. But that's an example of a company that has a negative retained earnings. Typically, this is going to be positive. Retained earnings will have a normal credit balance. Okay, so cash dividends. So we're going to talk about dividends in here. So retained earnings relates to dividends because dividends reduce retained earnings. But dividends can come in three forms actually. They can come in cash, they can come in non-cash items, and they can come in stock. And we're going to talk about all three of those. So the cash dividend is a distribution from a corporation to its shareholders. It's usually based on earnings. Usually companies do not pay a dividend if they don't have earnings, and usually they'll pay more dividends if they have more earnings, but it's not connected entirely. And we have three forms of dividends. We have cash dividends, stock dividends, and non-cash assets. We are going to talk about cash dividends. We're going to talk about stock dividends. We are not going to talk about non-cash assets. A company could, in theory, for example, Hershey's could pay dividends in chocolate, and I can't think of an example I know of where a company has paid dividends in a public manner that's not cash. So we're just going to do cash and stock dividends. Those are the two big ones. But non-cash does exist. Okay, So cash dividend is a distribution to the shareholders, and usually based on earnings, but not necessarily. And then we have cash, stock, and non-cash assets as possibilities for dividends. And of course, the accounting is different for them all. Okay, so cash dividends. In order to pay cash dividends, you need two things. First of all, you have to have enough retained earnings to declare the dividend. When you declare the dividend, you're going to reduce retained earnings for it. Retained earnings is this running total. Remember, of all our earnings to date, less any dividends we declare. Retained earnings, though, isn't cash. You also need you need enough cash to pay the dividend. So you need two things when you declare a dividend. Now, how do we declare a dividend? The board of directors has the authority to declare a dividend, and the company is not obligated to pay a dividend until it's declared. A company never, ever, ever has to pay a dividend. It is not a legal requirement until the board of directors declares a dividend. Okay, some companies pay dividends regularly. Utility companies pay dividends regularly. GM Corporation pays a regular dividend, a pretty good dividend. So several companies, usually established companies, pay dividends regularly. Other companies, typically those in startup mode, don't pay dividends. When stockholders invest in those corporations, they're investing in it for the stock value growth. So that you can take an entire course on dividend theory. There's no way, I don't have any way to say why a corporation pays a dividend or why they don't. That's up to the board of directors to decide. Some stocks, like utility companies, First Energy pays a dividend every quarter, and it's expected. And when people invest in First Energy, they invest expecting that dividend because that's what they do in their industry. Other companies, not so much. But the board of directors has the authority to declare a dividend, and until the board of directors declares a dividend, it has no legal obligation to pay. So a company could have paid dividends every quarter for the last 50 years. And this quarter, if the board of directors says no dividends, then they are not legally obligated to pay a dividend. Okay, there are three relevant dates with dividends that we need to know. And I'm going to go through an example. We have the date of declaration. We have the date of record. There is no entry on the date of record, and the payment date. Okay, I'm going to go through an example of a dividend declaration. If you have the PowerPoint slides, this is not in there because this dividend declaration was just done last week. So the company Molson Coors Brewing Company had a dividend announcement November 12th. So this was last week. So last week, Molson Coors, this is their press release, today declared a regular quarterly dividend on its common shares of U.S., and it's telling you what currency, 41 cents per share, okay? Payable December 15th to shareholders of record on November 30th. So there's 3 dates in that transaction, in that news release. The first date, the date of declaration, is November 12th, because it tells us in the press release that November 12th they did the declaration. On that date, this is a liability now, okay? So Molson Coors has paid a regular dividend for years. There's a history of a regular dividend every quarter. Until November 12th this year, this dividend was not a liability. But the board of directors has said, we're paying 41 cents a share, we've declared this dividend, so there is now a liability. Okay, so the next date here is the date of record. Now, on November 12th, when the board of directors declares this dividend, they have to have some way to say these people get the dividend. And keep in mind, stock transactions are happening every minute of the day. Stock is being sold and bought all the time. So what they do is they declare a date, and they say, here's our date of record. So they have gone here and they have said, whoever owns the stock at the end of close of business on November 30th gets the 41-cent dividend. Now they do that, they pick some date in the future. So November 12th, they said, as of November 30th, this dividend will be paid to everyone that's holding it on that date. Now, on the stock market, investors know this. So November 29th, this stock will trade for more just because everyone knows that this dividend is being paid on the 30th of November. And so that's the date of record. The date of record, there is no entry done in the accounting records. That is simply saying, here we're going to take a snapshot of all the owners of our stock at the close of business on November 30th, and then that's who's going to get the dividend. So that's the date of record. And then our final entry here, our final date, is December 15th. That is the payment date, or the date of payment, because they're telling us they're going to actually write the checks on December 15th. So everyone that owned it November 30th, they have a list of everyone who owned it. So December 15th, they're writing the checks and mailing the money, or doing it electronically. So those are the three dates with a dividend. And we're going to go over the accounting for those. Only two of the dates require any accounting entry. The first one is when they declare it, when they actually have a liability. And the second one is the date of payment. So we don't make any entry on the date of record, but know that it's important for knowing who's going to get it and who's not going to get it. Okay, so with that, let's switch products to Dunkin' Donuts. So Dunkin' Donuts declared a dividend, and okay, so Dunkin' Donuts has declared a dividend of 0.265 cents on February 15th to be paid on March 18th to shareholders of record as of close of business March 9th. So the question, I've sent it out, what is the date of payment? Okay, so in our example here, what's the date of payment? What's the date of payment? You have about 10 seconds left to enter your answer there. Okay. Okay, so the date of payment is March 18th. Okay, so it tells us. So we're going to do another one. Same example. So our next question is, what is the date of record? Okay, date of record. Okay, date of record. Got about another 10 seconds to get your date of record in. Okay, date of record is March 9th. And then our last question coming up, question 21, is asking the date of declaration. Okay, date of declaration. Okay, final 10 seconds. Okay, and the date of declaration is February 5th. So date of declaration, we're going to record the liability. The shareholders of record on March 9th, that's when just we don't make an entry, but that's who's going to get the dividend, and then the payment date is March 18th. Okay, so now we're going to talk about what happens on each of those dates. So let's say on June 19th, the board of directors declares a $50,000 cash dividend. So what's going to happen when we record a cash dividend, we're going to be debiting retained earnings because we need to reduce retained earnings, and we're going to be crediting dividends payable to set up the liability. So what's happening is our liabilities are increasing and our stockholders' equity is decreasing. So that's what happens when we declare it. So up in the corner you see declaration date. So on the date of declaration, we are reducing stockholders' equity and increasing liabilities. The question that's coming up in another couple slides, I'm going to be asking you the impact on the financial position, i.e. on assets, liabilities, and stockholders' equity of declaring a dividend. So you may want to write this down, that on the date of declaration, liabilities increase and stockholders' equity decreases. So on the date of declaration, liabilities increase and stockholders' equity decreases. So on the date of declaration, liabilities increase, stockholders' equity decreases. The date of declaration is also when it becomes a liability. You may also want to note that. Date of declaration is when this becomes, the dividend becomes a liability. Until the date of declaration, there is no liability to pay this dividend. Even if you've paid it every quarter for the last 50 years, it does not become a liability until the board of directors has declared it on that declaration date or date of declaration. So again, on the date of declaration, our liabilities are increasing, stockholders' equity is decreasing. So that's the declaration date. So on declaration date, liabilities increase, stockholders' equity decreases. We have a liability. Next up, we have the payment date. So the date of record goes by. We don't make any entry. But the payment date, when we pay the dividend on the date of payment, we're going to be debiting the liability, dividends payable because we're paying it off. We're going to be crediting cash. So on the date of payment, assets are going down and liabilities are going down. Okay. Okay, so question out there, the effect of the declaration of a cash dividend. So on the date of declaration, what happens to assets, liabilities, and stockholders' equity? Okay, so the effect when we declare a cash dividend, what happens to assets, liabilities, and stockholders' equity? It would have been in your notes just a minute ago. I'm going to close the question in about 10 seconds. Remember, any answer is better than no answer. Okay, so when we declare a cash dividend, we're going to increase liabilities and decrease stockholders' equity. Okay, and then we have one more. Be pretty straightforward here. The date when a cash dividend becomes a legal obligation is on which date? The date of record, the declaration date, the last day of the corporate year, or the payment date? When does it become a liability? Okay, about 10 seconds. Remember, an answer is better than no answer. So the date when a cash dividend becomes a legal obligation is on which date? Okay, and good. It's the declaration date. Okay, so that was cash dividends. We went through cash dividends, and cash dividends are the most common. And this is cash dividends we've talked about on common stock. Every company has common stock. Okay, it's the most basic form of stock. If you issue stock, you absolutely have to have common stock. Some companies, though, will have a special category called preferred stock, and they will pay preferred dividends. Okay, and we're going to talk about preferred stock and when they pay dividends in cash, what happens. So preferred stock can be have one of two features. This is an either or. Preferred stock can be cumulative, which means dividends not yet paid are called dividends in arrears, or they could be non-cumulative. Preferred stock kind of functions like debt. Preferred stock, those preferred stockholders have to be paid before the common shareholders can get paid. Now, if you have cumulative preferred stock, that means you have to catch up on all your past dividends for every year before you can pay common stock a dime, including the current year. All those dividends that you have not paid in prior years are called dividends in arrears. Dividends in arrears is not a liability until declared, but that's a running total if your preferred stock is cumulative. If your preferred stock is non-cumulative, then that means if you don't pay a dividend in a given year, it just goes away. But in any year before you can pay common shareholders, you have to pay preferred shareholders first. So cumulative versus non-cumulative is a feature of the preferred stock, and preferred stock is either cumulative or non-cumulative, and when you hear that, that's what it's referring to, is whether the dividends pile up. If you have preferred stock and you want to pay a dividend to your common shareholders, you have to pay preferred first. And if it's cumulative preferred, you need to catch it up from the beginning of time if you haven't paid. So preferred stock is kind of like sitting there saying, pay me first, and preferred stock also has a fixed dividend on it, meaning it's going to be the same dividend every year. Okay, and my next slide shows you that. So, for example, you can have 6%, 100 par value preferred stock would pay a $6 dividend every year if a dividend is declared. So, and how we do that, preferred stock will have a percentage and a par value. So to get the preferred stock dividend, you take the percentage times the par value. In this sentence, you want to underline par value because you'll have questions, maybe one coming up, that you have to figure out the preferred dividend, and it asks you, do you use the par value or the market value? You always use the par value. So to calculate a preferred dividend, it's always the percentage times the par value. Emphasis on the word par value, not the market value, the par value. So preferred stock, when you see that percentage, it's a percentage of par value, and that's the dividend. The dividend will never change. The dividend is going to be that same amount every year. And I want to go back to here for a moment, the slide right before this. Okay, preferred stock, if it's cumulative, the dividends, preferred dividends we haven't paid to date are called dividends in arrears. Preferred stock dividends that have not been paid to date are not a liability. Dividends in arrears is not a liability. That's simply a number, an amount of if preferred stock is cumulative, it's here's all the dividends we haven't paid yet on preferred stock. If it's cumulative, we cannot pay common stock until we catch up all the preferred stock dividends that have accumulated over the years. But it is not a liability. Dividends in arrears is not a liability. Dividends are never a liability until we declare a dividend. So that's what that is. I wanted to make that clear. If it's non-cumulative, then if we pass on a dividend in a given year, we don't ever have to pay it. But dividends are only a liability if they're declared. But cumulative preferred stock, every year we don't pay a dividend, the amount goes in a total, and that's called dividends in arrears. And that's just a number, not a liability, but it's just a number that we have to pay before common stock gets any money at all. And maybe we'll never pay a common dividend. That could be too. But, okay, so again, preferred stock pays a percentage of par value, emphasis on par value. It pays the same amount. This stock here, the stock price could be $2,000, and the stock is still going to pay 6% of $100. Preferred stock, same dividend every year, so it's always a percentage of par. Okay, what's happening from an accounting standpoint? We've talked about dividends a lot. This is retained earnings, the T account. First of all, beginning balance is a credit normally. Retained earnings has a normal credit balance. Then when we earn net income, it goes into retained earnings and increases retained earnings because it's credited. And then when we declare dividends, we debit retained earnings. And then our ending retained balance is hopefully in retained earnings is a credit balance. If we have a loss in a given year, the loss switches over to the debit side and reduces retained earnings. So that net income is over there in a credit because net income. If it were a net loss, it would be debited and reduce retained earnings. So that's kind of a summary of what's going on with retained earnings, how retained earnings is impacted. Okay, we're going to do a couple questions before we go on to stock dividends. Stock dividends are coming up next. We have a couple questions on preferred stock. So the first one is when preferred stock is cumulative, preferred dividends not paid in a year. So if we don't pay the dividends in a year, if we don't declare them, we're not paying them, we're not declaring them, what are those called if preferred stock is cumulative? Okay, preferred stock is cumulative. Preferred dividends not paid in a given year or not declared in a given year are called what? For this question, assume that the dividends are not declared either. Okay? So we have cumulative preferred stock, and we have dividends not paid. Assume that the dividends are not declared either. Okay, final 10 seconds or so. Okay, those are called dividends in arrears. Okay, so preferred stock, it's cumulative. We're not paying dividends in a year. Those are called dividends in arrear. Okay, one more question before we go on to stock dividends. Okay, and before I deliver this one, a share of 5% preferred stock has a par value of $50 and a market value of $75. The owners of the preferred stock will receive a dividend of what? So this one you will need to probably do a little math, multiplication. Okay, a share of 5% preferred stock has a par value of $50 and a market value of $75. The owners of this preferred stock will receive a dividend of what per share? Going to close it probably in about 10 seconds. $2.50 a share. It's always the percentage times the par value, always, okay, when we're talking about preferred stock. Okay, so now still on this area of dividends, now we're going to talk about stock dividends. Okay, so up to this point we've been talking about dividends that are paid in cash. Companies can also pay out dividends in their own stock. This is a proportional share distribution of stock to shareholders based on how much of the company they own. They'll get that relative percentage of stock. It's basically taking the same size company and dividing it up in smaller pieces. What happens when we do a stock dividend is we're going to increase the stock account and decrease retained earnings. Total equity is unchanged. The reasons companies will distribute a stock dividend will be they want to continue doing a dividend. They want to make shareholders feel like they're getting something, but they don't have enough cash. They might also want to reduce the market price of the shares. So what companies do is they'll say, okay, we're going to give you stock dividends, so you end up with more shares of stock, but the market adjusts for that. The market knows. It's like you had a pizza with 10 slices, so you recut it, and now you have 12 slices. You don't have any more pizza, you just have more pieces, and that's what a stock dividend is. If the stock dividend is small, relatively small, the company will record it at market value. If it's greater than 25%, we record it at par value. Okay, so a stock dividend, I have an example of one coming up. I'll wait in just a minute to talk about a company that recently did a stock dividend. Okay, so stock dividends happen somewhat frequently. One that was recently in the news is First National Bank Corp. This is of Northern California. First National Bank of Northern California announced its board of directors had declared a stock dividend. So they're not paying out cash. They're giving out additional shares of cash. And what they said is they're giving approximately 210,709 shares payable at the rate of 1 share of common stock for every 20 shares of common stock owned. So if you were a shareholder in First National Bank of Northern California and you had 20 shares of common stock, you're going to have 1 more share now. So now you'll have 21 shares after the stock dividend. So First National Bank of Northern California, for whatever reason, didn't want to pay a cash dividend, but they wanted to give their shareholders something. So they're basically just dividing their company up into more pieces, giving out more pieces, but then as a shareholder, you feel like you have more, and sometimes you do come out ahead because the next time when they pay the dividend, you have another share of stock to get a dividend on. So now it tells us the stock dividend will be payable December 28th to shareholders of record on November 25th. So again, we have those same dates. And then this last sentence, fractional shares will be paid at its closing price on the record date of November 25th. So fractional shares, if you're a shareholder and you only have 10 shares of First National Bank stock, you're not going to get another share because you have to have 20 to get 1. So what they're going to do is they're going to take their stock price on November 25th and pay you the cash for your fractional share. So that was just kind of interesting to look at a stock dividend. They don't happen frequently, but occasionally they do, and that's what a stock dividend is. It's not cash. Okay, and then our next category of things is stock splits. Stock splits are more major than a stock dividend. Again, we're saying you have more shares of stock than what you had before. A stock split will decrease the market price of shares. There are no accounts affected. Emphasis on no accounts affected. A stock split does not impact your stockholders' equity. A stock split saying, oh, if you have one share, you now have two. And I'm going to show you an example coming up. Something for you to write right under this category, not written on the slide. Stockholders' equity is unaffected, will not change with a stock split. So total stockholders' equity will remain the same before and after a stock split. A stock split is just splitting the number of shares in half or by 3 or whatever our stock split is. That's all it's doing. You are not changing stockholders' equity with a stock split at all. Okay, so companies, why do they do stock splits? Companies will do stock splits because primarily they think their stock price is getting too big to be achievable. So here's a stock split that made the news recently. Okay, so in June 2014, because this was a huge one, Apple last June did a 7-for-1 stock split. So if you had one share of Apple stock in June, after June you now had 7 shares of stock. So before the split, Apple had roughly 861 million shares of stock valued roughly at $650 each. So the stock split comes along and every 1 share of stock Apple had is now split into 7 shares of stock. And they then had approximately 6 billion shares valued at roughly $94 a share. So before and after the stock split, Apple's stockholders' equity is unchanged. A stock split does not impact total stockholders' equity. What the company's trying to do is reduce the market price per share of stock so it's accessible to more people. Because once you get up into $650, you can't just go buy one stock typically. You have to buy like a chunk of them, and that prices it out of the range of a lot of people. There was another reason that Apple wanted to lower its stock price because it wanted to be included in one of the indexes, like the S&P 500. It already was, but there was another one it wanted to be in. And in that one, they would not let anyone in who had a very, very large stock price because it would affect the index too much. So it would only allow companies in. It would only allow the top 100 companies in or whatever, but they had to be roughly around $100 stock price. So Apple wanted to be in that index, so it needed to reduce it. And there's a theory over time, old wives' tales or whatever, say that your stock price should be lower, not this huge, massive thing. So you'll see stock splits occurring. Apple has done lots of stock splits since its inception. In fact, okay, 1976, let's say you had 1 share of Apple stock, okay? Then you came along in 1987, so 11 years later, they did a 2-for-1 stock split. So now you have 2 shares. Your 1 share became 2. In 2000, they did another 2-for-1 stock split. So your 2 shares became 4 shares. And then in 2005, they did another 2-for-1, and your original 1 share is now 8 shares. And then in 2014, they did a 7-for-1 split, which is almost unheard of. And so now your 1 original share of Apple stock is turned into 56 shares. So Apple has been a company, as a company grows, oftentimes they will do stock splits just because you don't want 1 share of stock to be worth, what, $15,000, trading for $15,000. That would just, so stock splits are more of a housekeeping thing than anything else. Total shareholders' equity is not impacted by stock split. You don't, it's just simply multiplying the number of shares you have out there. Okay, so that brings us to another question. This one should be pretty straightforward. Total stockholders' equity remains the same before and after a stock split. True or false? Okay, total stockholders' equity remains the same before and after a stock split. True or false? I'm going to close this question probably in about 10 seconds. Okay, final few seconds to get your answer in. Okay, that is true. When we have a stock split, total stockholders' equity does not change. Okay, Exhibit 10-7 in your book, I just want to point this out. This is a really nice summary of the impact on assets, liabilities, and stockholders' equity of these different things that we've talked about. We've talked about lots of things. This is a nice summary. Might be nice to do a screenshot. Get the summary here. And that brings us to the end of this chapter. Again, the homework problem or two that we didn't do, I sent out links yesterday for. So I will see you on Monday. Next week we only have class on Monday because of Thanksgiving, so we'll do chapter 11 on Monday.